Yes, my name is Ali Kazmi, WTS Hans UK. And you are?
I'm Robert Wilson, WTS.
I think they know us anyway. Yeah. Would you like to introduce yourselves, please?
Yes, thank you very much for this invitation. My name is Michael Stöber. I am professor of tax law at Kiel University in the north of Germany. And I do a lot of national tax, but also European tax, and happy to be here.
And I'm Xavier Remond. I'm the head of international tax policy at the EBRD. That's the European Bank for Reconstruction and Development. It's a multilateral development bank that is headquartered here in London. We have about 70 member states, including the UK. The EU and the EIB are also shareholders. And we finance all sorts of projects in about 40 countries in Europe, Africa, and Asia by way of debt and equity. And we're tax exempt.
Yes. Ali, on very short notice, has me invited to take part at this panel. And I'm here the bad guy. What we've just learned that green transition may be a big story for fraudsters. And now we are talking about the responsibility in this area. There had been a lot of greenwashing going on, and everyone knows, etc. And therefore, this really triggers it. And also in the morning, we've learned, let's say, the world is in slightly disorder. A universal approach, probably of the ECG values. This universal approach is being attacked, and this really leaves a question about responsibility of tax, which is a component of ESG, in the financial services. And this also has and as I indicated, let's say, a lot of arbitrage opportunities had been created not to invest ESG conform. And the sentiment of a lot of investors, probably a little bit greedy, I just want to return short term. I'm not looking on a long-term perspective. And how the financial service industry plus tax should, let's say, live or not live, let's say, how they act as responsible players in this arena. And this will be, let's say, the topic of our discussion today. So the question, up to a certain degree, is this, let's say, core theme of responsibility, how you want to address this, because responsibility is a very vague, a very broad, a lot of philosophical concepts are behind it. How you structure how you would define responsibility from this perspective. Probably starting with you, Professor Stöber, sorry.
Tax responsibility for companies is more and more important, as you said, by the internationalization of economy. It's easier for companies to use tax arbitrage and to look for a country where the tax burden is the lowest. But this implies certain risks of tax evasion, which would be a criminal offense, and it's severely punished in Germany as in most other countries. Recently we have, beyond this topic of criminal offense of tax fraud or tax evasion, also a pressure upon companies to more tax honesty. For example, for big groups of companies, they have to report on their profits and on the income tax they are paying on their profits. So there's more and more pressure on the companies to avoid even legal forms of tax planning, of looking for the most, the lowest tax burden. And this is a new development, it's basically more or less an ethical pressure. It's not so much a legal pressure, because we are talking about legal tax planning, but there's more and more pressure to avoid even these legal forms of tax optimization. And in my personal view, I think this is not a good development, because who in the end pays if the companies pay higher taxes? The consumer, the end consumer, has to pay higher prices. This is inevitable. So, of course, we need all these provisions on criminal offenses by tax fraud, tax evasion. But I think this ethical pressure we have by certain new forms of regulation, such as reporting on income taxation for big groups of companies, is something that goes beyond the things which I consider proportionate and necessary.
Yes.
Yeah. So I think it's quite an interesting theme as to where what we're trying to do is find the loci, where does this exist? Because responsibility, there's going to be a mind at play. So it's very easy to look to external legislation, and in the past there was just the tax code. So you computed your tax liability, paid it across. But I think the whole movement towards the spirit of law and so on, those are interesting developments. So I think you do become a bit of a tax spiritualist. But beyond that, now what we've seen, to your point, is there specific legislation, and arguably UK is probably the furthest in its thinking around tax integrity measures, around the corporate criminal offense. So what is done is it's basically the legal concept of mens rea has now been put into the corporate body itself. And it's a strict liability offense. So you're guilty until you can prove your innocence. So I think that's an interesting development. Now, this is a discussion we were having with Simon York when the legislation was being brought in by the Treasury HMRC. And we said, well, it's a corporate offence, and then Simon York issues this note and says, and we will disqualify the directors. I'm thinking, hang on a second. You just said it's a corporate offence. So they localize it to the directors. Okay, so that's an interesting development. And also enablers legislation. So if you're a intermediary, then you're also participating because you're aiding and abetting. But these type of things, to me, represent the minimum that firms will do. But I think just as companies will have CSR policies, ESG and so on, I think there is a moral code, which, people will argue that, hang on a second, your duty is to return, make maximized returns to your investors, to your shareholders. Yes and no, but I think there is a corporate values that you stand for, and there's all these things you can get these days, fair tax mark and so on. So I think it is important for the directors to articulate what they stand for, what is their attitude towards tax risk, how they will pay, how aggressive they're going to be. And that's where we need to go. And if that is the case, it has to be not a bottom-up or external factors, but tone from the top.
Thank you. Development banks have been concerned about ESG for decades, and that used to capture things like environment, social issues, integrity in the broad sense. And tax is a new kid on the block in a way. It's been emerging over the last few years, and it was very interesting to hear Dan just before us, because even in an international organization that is really trying to serve the public, incorporation of tax within the ESG agenda happened as a result of external pressure. Pressure from people like Dan, journalists, and our case is a very good example. We did a very little bit until 2015, 2016, and then you had all these leaks, ICIG database, Panama Papers, Paradise Papers, etc. And we became under very heavy pressure from some of our shareholders, member states, who wanted us and other development banks to respond to that, to do something about it, because we didn't do much before that. And we were put under pressure. And I think it's fair to say that organizations like ours, but I'd say also citizens or corporates, would probably not do a lot if they were not put under pressure. That certainly happened to us. And so as a result of that, we beefed up our approach. We adopted a tax policy, which is publicly available, which sets our own requirements, which in turn cross-refer to global tax standards set by the OECD in particular regarding tax transparency, that's exchange of information, and also BEPS, base erosion and profit shifting. So as an international organization, we're not setting standards because our job is to finance projects, but we do support standards that are set by the experts at the OECD in particular. So that goes beyond the requirements of local jurisdictions. Now, these standards, it's not black and white. It's quite tricky to understand what they mean and how to implement them. But over time, we have developed a very practical approach. And so whenever we finance a project in the private sector that does have a cross-border ownership structure, we carry out detailed tax due diligence to make sure that the structure is consistent with global tax standards, irrespective of local requirements. And so we make sure that the jurisdictions that are used by the client are acceptable with reference to ratings and listings. We want to understand the commercial reasons for a particular structure. We want to make sure that there is an alignment between the corporate structure and economic substance. We want to make sure that the structure is transparent, and we want to understand what the tax implications are. So we look at all that, we assess, and it's a difficult assessment, whether on balance the structure is consistent with global tax standards. And if it's not, then we engage in a discussion with the client. We try to identify the risk. Well, we identify certain risks, and if we do identify risks, we may make our support, our financing, subject to certain conditions. Beef up your substance in Luxembourg or in the Netherlands. Make sure that you disclose the full ownership structure to the local authorities. That sort of things. Review or revisit your self-qualification for exchange of information purposes, etc., etc.
Yeah.
I think that's really interesting what you said, Xavier, because if we look at, take examples of banks, basically, when we look at the liability side of the balance sheet, financial accounts, and there's a lot of tax transparency measures, FATCA, CRS, and the like, so there is mechanisms already there. Whereas I think the asset side of the balance sheet, obviously institutions like yours, enlightened institutions, irrespective of where it might have started, and I would say big sovereigns also who reputationally they want to control themselves, you have come up with some sort of codes that you have put in place. But I suspect that most banking institutions, to your point, because there is no external regulations demanding them to look at who you should lend to and what is the tax, there isn't very much there in terms of framework. So I think you're at the cutting edge of this type of stuff.
That is very true, and we see that very much because we do a lot of intermediated financing whereby we lend to local banks for them to on-lend to SMEs in particular. And it's true that when it comes to integrity in the broader sense, we've got an integrity policy, but our FI clients have their own. They have AML, CFD, KYC processes, we review them. But when it comes to tax, we've got our policy, but they don't have anything. And it can be very tricky because when we, sometimes we use donor funds. And our own donors, maybe member states, who have their own policy agenda. And some members expect us to transpose our requirements. In other words, they would like us to make sure that our FI partners do the same vis-a-vis their clients, which is very, very tricky because local banks do not have anything equivalent. And to be honest, it would be impossible for them to implement what we do. Because I'm looking at, 200-300 projects a year. But of course, the local banks, they're looking at thousands or dozens of thousands. So you can't really expect them to carry out the sort of due diligence that we carry out, because the volume is just not comparable.
So let's say we see the development up to a certain degree, let's say what is legal and what's legitimate. And on the legitimate side, it's still legal, but tragedy of the commons and the opportunistic costs of, let's say, increased tax arbitrage, which affects society, how this is reflected and what is, let's say, the in-house standards in this respect. How you have high standards, you indicated standards in other jurisdictions and other partners of you are different. So how this should be articulated by, let's say, the C-level, by the head of tax, by the, what is their policy thereof?
I do a lot of tax integrity work, so I always, it's quite interesting because you will quite often go into an organization and there will be the head of tax, somebody in the tax department who wants to have a proper tax integrity framework. And I usually sort of like say, cajole them, convince them that it's got to start from the board. The articulation of what you are about as an organization has to have board buy-in. Without that, I think it's very difficult. We were talking about the case of tax authorities and their role. I think the approach I take generally when we're designing tax integrity frameworks is to actually start from the end game. You know, you sit with the board and you say, let us imagine that your name has already appeared. Dan McCram has written about you. What are you going to say about yourself? What evidence are you going to show to say, we had done this? This is an isolated case. This was a naughty person in our organization. And unless you have that kind of stress testing going on, how else do you build? I mean, you have to be forever ready for tax audits. I mean, that is the nature of the game now. I mean, I think we're going to talk technology next. The tools that the tax authorities have now, they are seriously advanced. I mean, the UK tax authorities, had BAE Systems design this 400 million system just to detect irregular patterns of behavior.
But coming back, this has to be articulated from the C-level, top down. If you, for example, look at a regime like DAX 6, the jurisdiction where I come from, Germany, there had been a lot of reporting. They overwhelmed up to a certain degree, to report everything in respect of potential tax arbitrage, which might be, let's say, in our discussion, or which should be is a question of responsibility of tax. Other jurisdictions in Europe, the figures are not really published, but what you see, more or less only not so many, put it this way, not so many structures had been reported. So we see there significant cultural differences. And how to play this or how to articulate this on the top level, on the C level. If you are a business and you see acting in a cultural environment which has probably a different approach than other or different cultural environment, there's an arbitrage between different cultures, and this is reflected how you articulate probably your tax policy, etc. And especially as an international player, might be quite difficult. I could imagine at least.
Xavier, you probably can add something to that, because how many jurisdictions do you operate in or lend to? How many jurisdictions do you lend to?
About 40. Yeah.
And I'm sure they're not consistent.
That's for sure. But there are cultural differences within the organization. Tax is a sensitive issue. Everybody's paying tax. And so that if you talk to staff, people will react differently. Within a large organization like ours, you've got people who see tax as part of ESG, and you have people who see tax as a burden, especially within the banking department. The people who find the clients, who are trying to finance projects, to make a return. So when you have conversations with your colleagues who are on the ground, who are financing projects, you will have a lot of pushback, as well as some people who support the agenda. And that happens at every single level of the organization, including at the top, including in board. And that's why I think it's extremely important for the top to get the right tone. And for instance, I've got a little team. We work a lot. We like our job, but we would be completely ineffective if we didn't know that we were able to count on the support of top management. And that's been the most helpful thing, because first of all, if you keep fighting with your own colleagues, you're going to quit your job pretty quickly. It's extremely tiring. And it's also, what I have experienced is that, luckily, the head of our banking department is something who has no sympathy for tax avoidance. He's no tax expert. He will not understand the details, and there is no need for him to understand the details. But he has no sympathy for tax avoidance. And that is very, very important, because people within the bank know that, and they know they're going to waste their time if they try to push back when there is really no case. And that's about your point about the C-suite. I think that Ali, you mentioned the end game. And that's very important too, because who's going to listen to the details? Nobody. Bankers are not going to listen to. If it goes in the newspaper, people are not going to listen to the details. You see? And so very often we have very difficult calls to make. What is okay, what is not okay, what is consistent with global standards, what is not. It's very hard to say. You have to use your brain to make a judgment call. And the reason people may have different views on tax issues, and that's fine. What you really want to avoid is to have your name in the paper. And you must be sure that if it is in the paper, you would be able to make a compelling case in plain English in 30 seconds or a minute, because beyond that, people will not listen to you anymore. So that's what you want to avoid, to preserve your reputation.
I think that's really interesting, because, and if I just look at our own practice, when do we get called in? People don't just sort of say, hey, consultants, come in, everything is fine here. That never happens. So something's either gone wrong, and it's usually a control function, the second line of defense, who'd call us in, or it's operationally become problematic because your counterparty is saying, your forms don't look right, you need to get some advisors. But the control functions are really interesting, because it'll be someone who understands tax or understands compliance, who's feeling the pain and is trying to bring about a change within the organization. They'll call the consultant and say, have I got this right? And that usually then requires some sort of behavioral change within the organization. And to your point, I think if the control function then has the support of the senior management, then you go to the first line and you say, guys, what kind of business are you writing? And you have to remind them, you're not the first line of offense, you're the first line of defense, okay? Which is quite often not well understood within organizations. They'll accept forms without validating, they'll just basically do silly things. But once you have the backing of the senior team, you say, no, it is unacceptable what you're doing. And I think that's really quite interesting, sort of like how it becomes less about tax, more about embedding change in behavioral and psychological aspects.
So you indicated, and probably this topic, as if I understand you correctly, is not really loved within the organization. So what is then, if it's not, and this reflects sentiment of a lot of people and probably also on a shareholder level. And then it's also for the C-level probably to articulate the policy quite difficult. Is ESG, is tax, or to refrain from tax optimization, probably you indicated this, Professor Stöber, it might reduce on a short term probably the value you might capture. So it's up to a certain degree a trade-off, short-term profits versus long-term expectations of better returns or more sustainable returns. And in our short, let's say, especially very often in financial service, or also myself as an investor, probably you look very often quite short-term and do not really care about the tragedy of the commons on a long-term perspective.
Yes, this is definitely a certain dilemma for the directors of a corporation, that they have, on the one hand, they have to increase the profits in the interests of the shareholders, and this also includes to avoid too high taxation. But on the other hand, there's increasing pressure to not to use these tax planning arrangements. So this is indeed a dilemma. But according to German statutory law, it's a legal duty of the directors to implement a compliance system, and this also refers to tax law. It's self-evident that the tax legislation of the country where the company has its domicile, but also of foreign countries, has to be respected. But we are beyond this now, because they also have to avoid tax planning arrangement. No one knows exactly what this means, and which is included in this duty of compliance. So there are no fixed rules, no written rules, and in the worst case, there may be a civil liability of the directors to their corporation or to the shareholders, and a criminal liability on the basis of rules that no one exactly knows, that are not written. So this, I think this is also with regard to constitutional law problematic, that we have a legal uncertainty. There's no legal certainty, and the pressure is growing, as I said, not only to avoid direct offenses against tax law provisions which exist in the different states in which the corporation has activities, but also to avoid tax planning and structures which lead to these BEPS problems. But no one exactly knows which is still morally acceptable, which forms of tax planning are not acceptable. So there is a complete legal uncertainty, and this, in my opinion, is also problematic with regard to constitutional rights, fundamental rights.
Well, that's interesting, because tax authorities have of late got into this bad habit of passing legislation that has retrospective effect. So that certainty point, the legal certainty, I think, is really problematic. And DAC 6, with the back book period, became a real issue for many institutions.
Yes, of course, this is an additional problem that we have also in Germany, retroactive tax laws. And well, the whole matter of tax compliance or ethical tax behavior of corporations is not clear. There are no clear rules on this, and this is definitely a problem.
I mean, I think Germany particularly, we were together talking to a very large Middle Eastern sovereign, and they were saying is we can't get our money out of the German tax authorities on withholding tax reclaims, which seems a bit odd because they have obligations, treaty obligations, but the Germans are not getting good press today, by the way. For the tax authority to behave in a manner that is unbecoming, I think, that in itself, I mean, I think it was a couple of years ago, the German tax authority bought stolen data. Is that the right way to behave?
Probably, therefore, I might be not the right person here to talk to these topics. What is about the responsibility? But if you see Germany, and as you described it, Professor Stöber, let's say the responsibility, let's say the first line of defense is to be as safe as possible from a penalty law perspective for the whole organization and probably for yourself too. And due to the fact that, let's say, this has been factored in, let's say the possible legal tax arbitrage is now being regarded as somehow illegal and might be retroactively just by, let's say, adaptation of, let's say, the interpretation or changed interpretation, even retroactively, might be regarded as penalty alike. Then, from my perspective, if you are a German company, you have to play it as safe as possible. And this is a minimum, let's say, responsibility you have to take. So you have not the issue, or it's from a business perspective not too good, but from let's say, to safeguard yourself and the organization, to play it as safe as possible. And this reflects why probably with DAC 6 you have thousands of cases being reported, because if you report it, you are safe. And then we have, let's say, the trade-off. If you establish a lot of compliance documentation and report it, then you are safe. Yeah. Whether you really intend to follow these rules, yes or no, from a legitimate perspective, is overruled. You safeguard yourself from penalty law and really comply as much, or compliance means documentation and transparent reporting as much as possible. And this is, let's say, the very specific German factor.
But Germany does project itself on a European-wide basis as well. I mean, a lot of FASTRA is shaped by CUMEX, and I think we talk about weaponization of taxation. I think there's a weaponization of tax liability, particularly under FASTRA. I mean, I think it will change the way things are done. I'm sure you're looking at it now as we speak.
Yeah, probably you can give us some more insights in this respect.
No, I meant
or as an international organization, let's say, how you already outlined it, that this is probably not really loved by everyone, and let's say, but this is the ultimate policy, and ultimate policy, thanks God, put it this way, in not every jurisdictions, this is, let's say, you have to factor in a fully fledged penalty law to be responsible or to act responsible.
Yeah, I mean, as I said, there is some pushback, but I think that you mentioned the question of culture change. It's just something that takes a lot of time. And so, for instance, at the bank, we set up this new function about 8 years ago. And at the time, there was a lot of pushback because it was seen as a burden, an extra burden in the process of approving projects and financing them. But over time, there has been a shift within the bank, so people are more and more considering that as a good thing to do, to have a responsible tax behavior. And people change. And what I see is that, generally speaking, the new joiners who replace the leavers are much more willing to accept that tax is part of what we have to look at, just like fraud and corruption, environment, etc., etc. So I think that, and there is much less pushback now than a few years ago. So that's a good thing. And we witness the same in our board. So you've got an increasing number of member states who care about that. And I'd say those who do not care or care less stay silent. There's nobody who's fighting for tax avoidance in board. So you only hear those who support the fight against tax avoidance. And we witness the same, we see a lot of tax reports from advisors to our clients. And I think it's fair to say, but Ali, you will know that better than I do, that the practice of consultancies have really shifted from trying to pay as little tax as possible to trying to ensure compliance. And among clients, it's the same. I'd say that we see a huge variety of clients because we deal in all sectors. We finance projects in about 40 countries, SMEs and M&Es that are headquarters in the Western world. So we have a huge spectrum. And I'd say that most of the time you can engage and you can improve things. So we're not in the business of telling people what to do. We're not setting rules, but we're looking at what they're doing and we try to see whether it's okay or whether there's something that is a bit borderline. If they're using shells, if they're paying no tax at all, if there is no full transparency, we're never going to take the view that something is wrong in itself, but we will want, all these are seen as risk indicators. We'll try to understand why that is the case and see whether or not there's a valid reason. Because there may be a valid reason for very little substance. There may be a valid reason for paying no tax. So we try, and maybe that's what you said about getting the right balance, we try to perform tailored due diligence. We try to understand. And that's where and in most cases we manage to support projects. And I'd say in between 15 and 30% of 30% of cases, we make our support subject to conditions. And that's where we manage to improve the compliance position. And I think that's a good achievement. And where you get nerve, and a risk indicator is not necessarily something to worry about too much, because sometimes you just point that to the client or their advisors, and their reaction, oh yes, you may be right. Let's look at that. Let's try to change that. And again, echoing what Dan said before, what is more concerning, in fact, it's not the technical details. It's the way clients react to what you find. If you find something and they engage, there is a good discussion, it does build trust. What I always find very concerning is those clients who do not respond, who give you inconsistent responses, or you pick up things that are clearly not right. That's what is concerning. And again, as Dan said, if a client does that, there's a high likelihood that they're doing other things wrong. And interestingly, in our portfolio, very often, when you see a very, very complex structure, using tax havens, no substance anywhere, no taxation anywhere, very often, our colleagues in integrity will also find out about integrity issues. And so you have this small minority of projects where there's really a problem, but it's very, very rare that we say no to a project just on tax grounds. In the worst cases, there will be other issues, and the project will die for a variety of reasons, including tax, but not just tax.
This probably references, let's say, Panama Papers or whatever. If you have to hide money, you have to implement tax structures, hiding tax structures too. And so it's alignment of various, let's say, incident factors which are not in line with, let's say, transparency regulations or prudent tax structuring. Very, very interesting. So, but ultimately, from your perspective, very positive, or you see a positive development, so that the responsibility is more and more accepted, and not only accepted, but also, let's say, implemented.
Generally, yes, but I think it's also very important to find a way of measuring the impact. So, institutions like ours are doing their best to improve the compliance profile of our clients. And we're not the only investors to do that. So development banks will do that, but a number of sovereign funds will do that, and a number of private investors who care will do that. So I wouldn't say that's the majority of investors, but you have a growing number of investors who care. And so to come back to the long-term, short-term discussion, well, people who in the long term will want to attract investors need to take that into account. Otherwise, they will not receive funding from those players. So we're trying to do the best, but we can. But we also need to be aware of our limitations. We're not auditors. We're not enforcers. If someone wants to fool me, they will be able to do that. No problem. Because we look at the surface. Our business is to finance projects. We don't have the resources to spend days or weeks investigating. So there is a limit to what we can do. And I think it's also important to try to measure the impact of these new global standards, these new responsible tax processes. As you said, all that is very complicated. It's a burden for taxpayers. And an important question is to know whether all that has a real impact. I'm hoping that what we do has a small positive impact, but it would be good for us, or maybe independent experts, to measure the impact. So what is the impact of all these, this exchange of information for millions of taxpayers? It's a big cost. What does it bring? What is the impact of these new legislation in tax havens regarding economic substance? Is it window dressing, or does it really make a change? And the feedback that I hear from the global tax community is that all that does have an impact, but perhaps still relatively limited. Same with Pillar 2. Very complex rules that apply across the board. We need to measure the impact.
Can I just ask a question of our
Of
audience,
course.
actually?
Yeah.
Could we have a show of hands? Because you are either financial institutions or you deal with financial institutions. Do you think tax integrity is where it needs to be, either in your organization or your client organizations? Who thinks it's reached the right level?
We are at the right level.
2 people, 3 people. Okay. Who thinks it isn't at the right level? And then there's the majority who are undecided. Okay, thank you.
But this is, let's say we are here in London, one of the financial centers, and let's say we are financing these structures or advising these structures, and the audience, it's a little bit vague about, and I think this reflects up to a certain degree our discussion.
Yeah.
The complexity, how to implement it, what is the short-term positive output of or what is the output of these implementations, what is the yes or no, internationally, no universal value pattern. Probably in Europe, yes, in other jurisdictions too, but not overall outside.
I mean, I wasn't surprised by that, by the way.
Me too.
And because I think the complexity of the code has become so much, the expectations, and I think you were referring to that as well. We're in very uncharted waters.
I would like to refer to this topic of effectiveness of these new measures. I think it's very doubtful to take this reporting obligation with regard to cross-border tax arrangements as an example. We have some data from the German government only until 2023, but by that date there were from the implementation of this reporting obligation until I think it was the end of March of 2023, there were around about 27,000 reports on cross-border tax arrangements. But how many were considered by the responsible authority as worthy of going more into it? 24. And this reflects quite well that this is completely ineffective. And it's another point. No one wants to advocate openly for tax avoidance, but there is a fundamental right to tax avoidance, which is acknowledged by the German Constitutional Court and the ECJ. By the ECJ recently in its ruling from July 2024 on this reporting obligation. Well, in the result, the ECJ said it's okay, there is no violation of the fundamental rights of the European Charter of Fundamental Rights. But in the beginning, the ECJ said clearly there is a fundamental right to organize tax matters in a way that you pay the least amount of taxes possible. This is basically a fundamental right. So every restriction of this right has to be justified. And this is completely, in my view, this has been completely forgotten by the legislator on the European level and even more on the German or the national level.
Thank you very much.
Questions? We have time for questions.
Oh, yeah. Okay.
We talked a lot about the responsibility of the taxpayer. I think, Professor Slüter, you were the one also mentioning, you were the one also referring to the responsibility of the legislator. I mean, tax law is the one aspect where we all feel the force of the government every day. And I would say the legislator also has a responsibility to treat his power responsibly, but also the tax authorities. We see how they start to implement changes retroactively, which have massive effect. Nobody knew about these things at the time things were happening. It's not responsible to treat this piece of law in such a way. Trust is eroding. Maybe that's my remark.
Yeah, basically it's two sides of the same coin. On the one hand, the state, the tax authorities require the taxpayers to comply with the tax legislation, but on the other hand, the state also has to do this. And in Germany we have, for example, a problem of treaty overrides. Germany has almost 100 double taxation agreements, but they make one treaty override after the other, which means that in domestic law they have provisions which are in contradiction of the double taxation agreements already concluded. And I think this is also a problem. Germany is not the only country which does this. The United States also do this, maybe UK also. But, well, if the state does not comply with its own rules, so why could he require the taxpayers to do this?
And this reflects, we are talking about very often, or if a comment is allowed, we talk about the tax law. Tax law is, from my perspective, very often the difficult political compromise. And within the, let's say, national tax environment, we see different arbitrage structures which by itself are very questionable. So if the legislator, by political compromise, because who wants to pay taxes, but revenue is necessary, and you have different lobby groups and different interest groups, etc. And we talked about that the tax system as such might overall not be sustainable, as we learned in prior keynote. Then it's a question, what is the add-on responsibility to, let's say, add an additional layer of on top of the legal framework, on an ethical, moral framework, and refer to an individual or to a corporation acting in a specific environment. So if tax law would be a monolith system, I would agree that in case, but knowing how tax law is usually established, what is a political process behind it, it is very difficult to add on additional layers of moral features.
It's, if I may add, I mean, it's not an issue we have to contend with any longer, but I do remember the good old days when the United Kingdom was a member state of the EU, and any measure that came out of the EU was completely resisted by the United Kingdom. Absolutely, we just said, no, 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 Europe's not going to do this. But once it became a directive, UK would go completely the other way and implement it on time and write the guidance and so on. Even today, I think the DAC 6 guidance the UK HMRC has is still the most deep out of all the European member states.
Because you invented it. And the EU copied it.
But what I find odd is in the EU, it's supposed to be a common to all the member states. Whatever comes out, it is never common, is it? Well, we don't have to deal with it, but you have to deal with it.
Okay.
On that happy note.
Yes. Thank you very much.
Thank you.
Thank you.